All right, let's talk about something every single investor goes through, but nobody likes to talk about drawdowns. Those just awful, gut wrenching periods when your portfolio's value just keeps sinking. But what if I told you there's a way to not just endure the storm, but to actually use science to come out stronger on the other side? Let's dive in.
You know that feeling, right? You're watching all that red on the screen, and you feel that knot forming in your stomach. It's so much more than just numbers on a page, isn't it? It feels like a real battle, an emotional one. And today, we're going to unpack the science of not just surviving that battle, but actually winning it. So, first things first, we have to understand the enemy. And here's the twist. The real enemy isn't the market itself. Nope. It's usually our own emotional response to it.
So let's get on the same page. What even is a drawdown? Well, technically, it's just the measurement of a drop from an investment's highest point to its lowest point. It's a totally normal, expected part of investing. But man, when you're in the middle of one, it feels anything but normal.
And that's because a drawdown unleashes this whole cocktail of really awful feelings. There's the fear that it's just going to keep going down forever, the anxiety about your entire financial future, the frustration that your great strategy suddenly isn't working. It's a powerful and deeply personal experience.
So why? Why does it hurt so much? Well, it turns out there's a core psychological reason, a little quirk in our brains called loss aversion. Research shows, and this is wild, that the pain of losing, say, $100 is felt about twice as strongly as the joy of gaining that same $100. Our brains are literally hardwired to avoid loss at all costs, and that can push us to make some, let's just say, less than ideal decisions.
And this is where things can go really, really wrong. That bias kicks off this disastrous chain reaction. The market dips a little, that intense fear of loss completely takes over, and boom, we hit the big red panic button and sell everything. And the real kicker? In our desperate attempt to avoid more potential losses, we end up locking in the ones we already have, completely sabotaging our own long-term goals. Okay, so that's the problem. Our emotions are the enemy. So what's the solution? Well, the answer is to take emotion out of the driver's seat and replace it with a cool, calm, data-driven scientific strategy. This brings us to some really cool, really powerful stuff, starting with modern portfolio theory. Now, the big idea here isn't to try and avoid risk completely. That's just impossible. Instead, it's all about intelligently combining different kinds of assets. The magic word, you've heard it before, is diversification. The whole point is to own a bunch of things that don't all go up or down at the exact same time. It smooths out the ride.
But how do you know if your portfolio is actually doing a good job of balancing that risk and reward? Well, one of the most important tools we have is called the Sharpe ratio. Just think of it like a grade for your portfolio. It basically tells you how much return you're getting for the amount of risk you're taking. The higher the Sharpe ratio, the better. It means you're getting more bang for your risk buck.
Which, of course, is the multi-trillion-dollar question, isn't it? I mean, with thousands of things to invest in, how on earth do you find that one perfect combination that gives you the absolute best Sharpe ratio? To find that perfect mix, you have to bring in the big guns. Researchers use some really powerful computer techniques to map out what's called the efficient frontier. The engine that drives this whole thing is a method called a Monte Carlo simulation. Now, that sounds complicated, but the idea is pretty simple. A computer basically creates tens of thousands of different possible portfolios, each one with a totally random mix of assets. Then it calculates the risk and return for every single one. It's kind of like testing thousands of different cake recipes to find the one that is absolutely, positively the most delicious. And this is what comes out on the other side. Every single one of those little dots is a portfolio the computer created. The line going up is return, the line going across is risk. Now, that big curve is the efficient frontier. It represents the best possible return you can get for any level of risk. Anything below that line is, well, not as good. And that little highlighted dot right there, that's the holy grail. That's the one portfolio with the highest possible Sharpe ratio.
So, the big reveal. What does this perfect portfolio actually look like? Well, using data from the Indian market between 2011 and 2021, this is what the computer came up with. And it's a fascinating mix, isn't it? You've got your steady blue chip stocks, sure, but you also have big chunks of things like gold ETFs and even Bitcoin. The reason is that these things tend to dance to their own beat. They move independently, which gives you that powerful diversification. This is the data-driven answer to our emotional problem.
Okay, great. So we've got our scientifically optimized portfolio. We're done, right? Well, not quite. Building it is just step one. The real trick is maintaining it. And that's where a strategy called rebalancing comes into play. See, over time, some of your investments are going to grow faster than others, and that's going to throw your perfect mix all out of whack. Rebalancing is just the simple, disciplined act of checking in, selling a bit of your winners, and buying a bit more of your underperformers to get everything back to your target weights. In the study we're looking at, they did this like clockwork every 90 days.
So, the big question, did all this work in the real world? Let's look at the results. This chart is incredible. It shows what happened to 100,000 rupees over a decade. That green line is just the market index, the Nifty 50. The orange line is our optimal portfolio, but just left alone. And that soaring blue line, that's our portfolio with that quarterly rebalancing. I mean, the difference in the final outcome is just staggering.
Let's put some hard numbers to that graph, because they're pretty wild. The standard Nifty 50 index turned 100,000 into about 279,000. Not bad. Our optimized portfolio, without rebalancing, did way better, getting to 436,000. But the rebalanced portfolio, the one with the regular tune-ups, it just blows the others away, ending at almost 500,000 rupees. That's an annual return of nearly 50%.
Now, there's no such thing as a free lunch in investing, right? There's always a catch. And as you could see on that chart, the price for those incredible returns was a much bumpier ride. The rebalanced portfolio had way bigger swings, greater volatility. And, of course, every time you buy and sell to rebalance, you rack up some small transaction costs.
And the study was super transparent about this. Over that entire 10-year period, all those rebalancing moves cost a grand total of about 12,500 rupees. But when you remember that it made almost 60,000 extra rupees in profit compared to the portfolio that wasn't rebalanced, well, that seems like a trade-off that was definitely worth making. All right, so let's boil this all down. What are the big things to remember? First, drawdowns are tough for a scientific reason. Our brains are just wired to hate losing. The best antidote to that is to fight emotion with a disciplined, data-driven plan. That plan should be built on diversification and optimization to find that sweet spot between risk and reward. And finally, as we saw, consistently rebalancing that portfolio can seriously boost your returns as long as you're okay with a bit more volatility and some small costs along the way. So I'll leave you with this one final question to think about. Now that you know just how easily our emotions can lead us down the wrong path, and you've seen how powerful a data-driven system can be, it's worth taking a moment to ask yourself, where does your own investment approach fall? Is it run by gut feelings and fear, or is it run by a disciplined strategy? Definitely something to think about. Thanks for joining us.